Back on Newsmaker, just 6 years ago, a 30-year mortgage dropped to 3%, and many Americans jumped at the chance. A 30-year mortgage today is double that, right around 6%. Rates have been falling recently, but for many who might want to consider other housing options, leaving that low interest rate in the threes is an agonizing decision. Trevor Halpern is the CEO of Halpern Real Estate Residential at EXP. He's a Phoenix native, graduate of ASU's College of Law, and the #1 independent agent at EXP Realty in Phoenix. Trevor, thank you. Good to see you.
Thanks for having me.
Okay, you call this, I had to laugh, you call this the golden handcuffs, having that low mortgage rate and then thinking, I can't move now, I'm doubling my rate if I move.
That's exactly it. These are conversations I have with my clients all the time. You get locked into a 2 3/4 or a 3% or the 3.5% rate, and you're looking at 6% nowadays. The natural inclination is to say, I'm not moving. I can't give up this rate.
Do you kind of tell them historically that even 6% is that's a great number? I mean, in the 80s, we were around 15% or even higher for a mortgage. People, who weren't around then can't even imagine that. So historically, 6%, that's not bad.
Exactly. I mean, 6% is trending right along the 30-year average for 30-year fixed mortgage rate. So you're doing pretty darn well. And right now, I mean, even yesterday, we saw rates dip into the high fives. And traditionally, when we see rates solidly in the fives, as mortgage lenders like to call it, a 5 handle, when we're in a 5 handle, we're going to see activity pick up dramatically.
We've got right now across the country, and it kind of stunned me, the glut of homes out there for sale, and the Sunbelt states are really feeling it. Phoenix, Austin, Vegas, these kind of, destination sunshine markets have a glut of homes out there. What's going to cause people to finally move? Do you think it is that move into the fives?
Yeah, I do. Here in Phoenix, we have a supply and demand imbalance. We have more supply than we do have demand. So the only thing that's really going to balance that out, or one of the mechanisms that can balance that out, is mortgage interest rates dropping. So if we solidly get into the fives, let's call it 5.5, 5.25, we are likely to see more people, more buyers enter the market. Now, buyer beware. As interest rates, the traditional thought is when rates go down 1%, so let's say from 6 to 5, 1 million buyers across the country are going to activate. And when they activate and buyers go out and start gobbling up the inventory, it applies upward pricing pressure. So as you're waiting for interest rates to go down, you may wait for interest rates to go down, but you might be buying the same home at a more expensive price. And now you're looking to say, okay, well, what does that do for me on a monthly price basis in my mortgage payment? And sometimes it's a wash. So it really depends on rate and it depends on price. But if you wait too long and activity rears its head and people start gobbling up inventory, we can expect prices to go up.
That is really interesting. Yeah, it was only a few years ago we were in a pricing war with every home that came on the market. It was just going up, 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 up.
Yeah, it was crazy. I mean, back in the COVID days, as a real estate practitioner, I often had people say, man, it must be good to be in the business. And I was like, I'm not sleeping. I'm not seeing my kids. There was so much activity, and we'd hold an open house, and 35 people would come through in a day, and we'd have 3, 4, 5, 6 offers per listing, and have to manage it all. So, it was good for consumers who captured a great property at a great interest rate, but it all has its pluses and minuses.
Before we get into the golden handcuffs issue, tell me right now, what is the average home in Phoenix? How long is it staying on the market?
It is so predicated on area, area, neighborhood dependent. What I will say broadly is that the neighborhoods in the central part of town, homes are selling more quickly than the outlying areas. And when we look statistically, we see areas like Buckeye tend to have a longer day on market and tend to be more of a buyer's market than some of these central neighborhoods in Phoenix. And that's always kind of been the case with Phoenix. You drive out, and they used to call it drive till you qualify. You move further and further until you can qualify for the home. And once things constrict a little bit, people want to be back in the center of town. And so we're seeing the demand in the center of town higher, which means days on market are lower in the center of town than they are on the exterior.
Is it a couple of months? Is it 37 days? What is it right now, just on average?
Yeah,
Do you have a number?
We're looking, broadly, let's call it about 60 days on market.
60 days
to get a home sold.
Okay.
Yeah.
Okay, now talk to me about this golden handcuffs issue. Somebody's got a mortgage in the threes that they got years ago, probably around the COVID time, right? That would have been the sweet spot.
Yep.
So now they're maybe older, kids have moved out, let's say. Not that I'm speaking from experience. But you might be thinking about other options, downsizing, moving somewhere else, looking at a smaller place, whatever. And they say, I can't give up this rate. This rate is historically low. How do you guide them on that?
Yeah, that's a great question. These are conversations, again, I have frequently. And I always try to encourage my buyers and sellers, regardless of their financial situation, their rate, their scenario, to balance logic and emotion. So if you are just in a logic mode and there is no emotion, or the emotional quotient is low and the logic is high, you're not in what I call the decision-making zone. So I always encourage people to balance that logic and emotion. So think, okay, I'm at 3% or I'm at 2.5%. My logic is up on this. I have to stay. My monthly payment is super low. But you go, my home doesn't serve me anymore. I hate driving home. I hate the street I live on. Or, we have a big home and we're empty nesters now. Or we bought this house and we had no kids. Now we have 2 kids and it doesn't serve us as much. And those two things, that logic and emotion, have to be balanced so that you can make sure that where you lay your head at night is appropriate for your current life scenario.
That is so well put, because, sometimes everybody's kind of arguing, take the emotion out of it. You're saying that a home purchase is a very emotionally attached decision, and you should let that be part of it.
Absolutely. Those things should be balanced. I mean, buying and selling a home is a rare time in the American life where you should be balanced.
Okay, Trevor, just break down the numbers for me. I haven't done the math on it. Let's say you're at a 3. You got it at the very lowest. You've got a mortgage on a, let's say it's an $800,000. Let's round it off. Okay, let's just say a $500,000 home. That's close to the median in Arizona. It's a little lower than that. $500,000 home at 3% versus a $500,000 home at 6%. How much more are they going to be paying monthly for that?
Yeah, well, that's a great question. I'd have to bust out my mortgage calculator to nail it exactly. But can I give you a very similar scenario?
Sure.
Okay, so if you buy today a $500,000 home at 6%, and let's say you've got that mortgage payment roughly around $3,200 a month with insurance and taxes and whatnot. If you waited until interest rates were down at 5, you can anticipate that home likely costing about $525,000. So if you waited for interest rates to go down and you bought an asset that's a little bit more, now you're going to be spending about $3,100 a month. So your wait, all of that waiting for interest rate to go down, you're actually only going to save about $100 a month on a $525,000 home.
Okay, that is a great explanation. And the other part of this is you can always refi. If rates start to really decline, you can jump back in and refi the house.
Absolutely. Refis are a massively powerful benefit to home ownership. When rates were really high, our industry, real estate agents and mortgage professionals had a saying, and it was, marry the house, date the rate. You're marrying your house, you're dating your rate. You can always change your rate out with a refi.
You got a million of them. I love this. Okay.
I do. I'm a dad. I have dad jokes too.
No, that's good. That's good. Okay, I've got to ask you about a couple of things going on in even in Washington. President Trump's State of the Union. He talked about banning large Wall Street investment firms from buying up single-family homes because homes, he said, are for people, not corporations, and the corporations are doing fine. How will this affect the market on the ground?
Yeah, on the ground, I will tell you, especially in the lower price ranges, like the starter home or the homes where people qualify for down payment assistance programs. Those are where most of these hedge funds and big big commercial entities are coming in and purchasing. So they are really affecting the lower end of the market. And so if you as a consumer is out there trying to buy and you're competing against a company that can just pay cash, they can come in, pay cash. They don't really care about, they want to make sure the house isn't going to fall down, but they're going to go in and put some money into it and turn it into the rental market. So what happens is you, as someone who is maybe putting 3.5% down, very hard to compete against an entity that is bringing cash to the purchase. And most of the sellers, they don't really care. Some of them do. Some have some emotion wrapped into it and want to make sure that it goes to the right people. But most of them, if you're dangling a bag of money in front of them, they're going to take it. So on the ground, it is the consumer in the entry-level area of our market that is most dramatically affected by having to compete with these large cash-buying commercial entities.
So this idea from President Trump, and Trump, he really kind of prides himself on a market-driven guy. This is not exactly market-driven. He's stepping in and saying, no, we're not going to do that.
Yeah, you got it. And that's where I am relatively conflicted, right? I'm a free market guy. I deal with the free market, with home sales. It's what is a seller willing to sell it for? What's a buyer willing to pay for it? It's free market principles. And so when the government comes in and says, this is how it is going to work. On paper, it sounds really nice, but what we find, whether it's the government reintroducing wolves into the wild or whatever it is, we always see unintended consequences. So although it sounds really good and although it may protect some consumers on a certain level, we don't know what those unintended consequences of such action could be.
That's a great point. Trevor Halpern, CEO of Halpern Residential at EXP, and that was a very interesting 15 minutes. Thank you, Trevor.
Great. Thank you for having me.
We'll do it again because this is in flux. The whole market's in flux.
Always.
Okay. We'll see you again, Trevor. Thank you for your time. We are back in a moment on Newsmaker.